We now move on to the next speaker, David Wendel. He's CEO of First Venture. And First Venture invests in strong entrepreneurial teams in technology, health, and sustainability. So, you're right here. You have the floor.
Thank you very much, Katarina. Good morning, everyone. Thank you for joining me at the 2021 Naventus Tech Summit. It's really fun to be here seeing such incredible companies with great visions, and I'm honored to be presenting as one of them. My name is David Wendel. I'm the CEO of First Venture. And for the coming 15 minutes, I want to talk to you about a crucial aspect in the advancement of technology, but also one of the big stones in building the leading stars of the future technology industry. But before going there and showing you the value creation and the economic growth that First Venture has been building for the past 15 years, I want to give you a brief history and background on First Venture. So we were founded in 2006, which makes us somewhat of a veteran within our space in the Swedish VC segment. And our investment strategy differs in some senses from a lot of the other VC players out there. But to start with the basics, First Venture invests in companies within the technology, sustainability, and health industries. These are three megatrends, and the reason for us to invest in these specific industries are quite simple. One, these industries has a real chance of actually driving a positive change for humanity and for the world. And secondly, these are huge industries that are undergoing some significant and fundamental change, mainly driven by technology, as through digitalization, automation, and AI as examples. And when this happens, when multi-trillion-dollar industries are undergoing this kind of fundamental change, it invites new players, new companies to enter the scene. And if they do that kind of onboarding in the right way, the potential of growth is huge in a relatively small period of time. And that is why these areas are so interesting for us. But it's not enough just to identify these megatrends. We also need to identify the best and the brightest, the companies with the biggest growth potential within these markets. So, First Venture invests in listed and unlisted companies. We only invest in companies with high growth potential, but mainly and most importantly, we invest in strong entrepreneurial teams. And I want to pause on that for a second, because this might sound like a given way of working, but for us at First Venture, this is really the key to our investment strategy. We believe that the entrepreneurs, more than the product or the sector, is the key for success. And when we evaluate companies for new investments, we put an especially big focus on the entrepreneurs. We evaluate them based on 18 different aspects. And this evaluation process doesn't only help us to get to know the company and the entrepreneurs, it also helps us understand if we are the right investor for this company and if they are a good match for our portfolio. And the way we look at investments, mainly focusing on the entrepreneurs, it differs slightly from many of the other VC funds out there. And I think the best way of explaining this is one of our founders, Rune Nordlander, he expresses the investment strategy as looking at our investments is looking at like a marriage. If you base a marriage solely on financials, pushing money in and expecting money back, it's not going to be a very fun or healthy marriage. The way we see investments, the financial is a big part of it because that can help the company. But we want to be an active and a long-term investor. And what that means is that we're talking to each other, we discuss the future, we have a common vision, and we know where we're going. And with this dialogue, we can help the companies. We've done this journey with multiple companies throughout the years, and we can help them not only with the financing, but also with the knowledge that we've built up during the past 15 years. And I think that is a really good value proposition, both for our portfolio companies, but also for our investors. But before I jump into how we create this value and build the economic growth, I want to talk about something that I'm really proud of. And that is the fact that First Venture went public earlier this year. And there are many reasons behind our IPO. But the reason that I'm the most proud of is the fact that through First Venture, anyone can now invest in really interesting, high potential growth, unlisted companies. Because we all heard the success stories before. Swedish startups becoming unicorns, founders becoming billionaires, and investors making a lot of money in the process. But for the general public, for people like me, this has not been accessible before. I would love to have invested in Spotify during the first year when they made their first round, but that kind of investment questions goes to institutional investors and to some high net worth individuals. But by investing in First Venture, anyone can get access to these really interesting, high potential companies. And that makes me really proud. But moving on and show you what our value proposition is really about, I need to take you back and look at a typical startup or scale-up journey. So everything starts out with an idea, right? If the founders of the company has the guts to actually go for it, they go through the phases of research, then development, they launch the product, and eventually they end up in a commercialization phase, meaning selling, marketing, distribution, building the teams. The challenge for most companies is that all of these steps, they cost a lot of money. And of course, you have an initial investment from the founders, from family and friends, maybe even from incubators or government grants. But the costs, they keep consuming this initial investment at quite a steady state. So if I throw up a curve on this slide, an accumulated cash flow curve, it's quite clear that to make these advancements and to drive technology forward, you're going to have to accumulate a lot of costs. And the challenge for founders in general are that this initial investment is eaten up way before the product is ready for launch. So of course we have the angel investors. They try to secure almost like a bridge financing up until the product is ready to hit the market. That is great. The big challenge for the founders then is that when you have the product ready, you want to reach out to the world, you need to start the commercialization phase. And that is really expensive. You need to invest in marketing, building the team, sales channels, and distributions. So it's a big dilemma here. You burnt through the initial investment, a lot of the angel investments, and now you need to invest even more to get this going. If you succeed in this shift, you can see that the cash flow curve starts to increase. And at the bottom of this valley, you have what's called the valley of death. And it sounds terrifying. For some companies it is, but if you know how to navigate it, it doesn't need to be. But the valley of death essentially is that tipping point, just before the product starts to become successful. If you manage to bend that curve, you can get some really good returns on the investment. And that is why early VC funds, like First Venture, are trying to invest in this space. If the company succeeds to do that, you have a product success. It's making more money than it's burning, which is great. And if we follow that trajectory to the northeast of this graph, we have a business success, which means that the company is not only generating money, it's generating returns for the investors. So the big question here is, what is the optimal timing for First Venture when we're looking at investments? It is this part, from the bottom of the valley of death and onwards. And the reasons for this are, well, many, but mainly this is the point where the companies need the funding the most. They're about to start the commercialization process, but they need a lot of money to do it properly. Statistics show that only 1 in 9 companies survive the valley of death. But at the same time, almost every single company out there have been in this in the valley of death at some point, and often at several times. So it is crucial to get the right funding in order to make the commercialization successful, because you can't go cheap in this stage either, then you're not going to success. And if companies die in the valley of death, it's not only sad for the company, but for the world. We lose a lot of great technology that could have been developed and see the day of light. So this is really the sweet spot when we're looking at the timing of our investments. And of course, there are later kind of financing alternatives as well. So now we know that First Venture, we invest in tech, sustainability, and in health. We know that we're focusing on strong entrepreneurial teams, and we know that this is really the sweet spot that we're looking at investing in. But what does that mean in practice? I mean, it sounds like a great investment theory, but I want to show you that this actually works as well. What you see here is the current portfolio of First Venture. We have 3 listed companies, and we have 7 currently unlisted companies. The companies that are listed today, we invested in when they were unlisted, but we love them and we see great potential for the future, so we want to stay there not only up until the IPO and then leave, like some VC funds, we want to stick with them, because these are great companies with a lot of potential for the future. And I would love to present all of them, because they're all amazing. But I know that I'm starting to run out of time, so I promise that I won't. But one of the companies that I wanted to present today is Kiliaro. It's an amazing technology-based company with a fantastic team behind it. But luckily for you, we have Kiliaro here today, so I'm going to save that presentation for Eli and for the afternoon. But in order to show you our investment strategy in practice, I'll run you through 3 quick examples. And I want to start with Humble Group. So just quickly on Humble. Humble Group is a FMCG group currently consisting of 24 companies, and they sell everything from sugar reduction products to sustainable health and beauty. We invested in Humble Group back in 2011. Back then, it wasn't a Humble Group, but it was the first piece of the Humble puzzle. It was called Bain Europe. And as I started out saying, the way we invest, it's active and it's long term. You see there is not a 3-year or even a 5-year horizon. We want to stick with the companies as long as we see that there is potential. And it's active in the sense that we talk to the company. We help them evaluate strategies. We help them to get out of the valley of death and grow beyond. So that's the way we approached Humble. And given that this is 10 years ago, I kind of have the results. Is this a good investment strategy or not? Well, if we look at just the numbers, year to date, rolling 12, rolling 36, it's quite clear that Humble is onto something big. This is an amazing company and it keeps on growing. And I encourage everyone just to go into the Humble Group's website and see what they're doing. I could talk about this for hours. But just to highlight the First Venture part of this, and not only talking about Humble, when we invested in Bain, the company was valued at around 8 million Swedish kronor. And if we fast forward today, with the active investments, with everything that the entrepreneurial team has done together with us through the dialogues, they are now at a valuation, a market cap on 7.6 billion. This is actually higher now. I sent in the numbers Tuesday, and it's been going up since. So this investment strategy, it's not only really interesting from an investor's point of view, but we help these companies get the best tools and knowledge in order to make these journeys. And don't get me wrong, it is the entrepreneurs driving this, but we can be a big facilitator. We've done this journey so many times with companies from different sectors, and we can be a big contributor to the journeys of the companies. The next company I want to talk about is the latest addition to our portfolio. It's Mendy. This is just a couple of weeks old. Mendy is a brain training company based on both hardware and on software. The hardware part you see on the upper left picture, it's a headband. And when you put it on, the sensors in the headband starts to analyze your oxygenated blood flow and brain activity in the frontal cortex, basically the part of the brain that makes us human. And those signals are transferred to the software, the Mendy app. And in that app, you get statistics and analysis of how your brain is working. You get training exercises. But the coolest thing for me is that I control the app solely by using my brain. And this company is just in line with what First Venture wants. It's front-end technology, it's run by a great team, and we have great hopes for the future for Mendy and Moa and the team. And last, but definitely not least, I want to talk about CombiQ. This is really a tech-driven company. We heard about the Internet of Things today. What CombiQ is doing is helping machines speak to humans. So basically, help machines that are not designed for the Internet of Things to still be connected. So the value chain begins with the industrial sensor nodes, or the ISNs. You can place this on any type of machinery, like chainsaws or up to industrial machines. And these sensors have 9 internal sensors and 3 external, and that helps gather data from these machines. That data is being sent to the base station and then up to the Combi Cloud, which is a SaaS platform that helps gather data, store data, and analyze data. And when you have that, we as humans can understand how the machines are feeling. And based on that analysis, we can prolong the life cycle of the machines, we can reduce fuel consumption or electricity consumption, and we can help maximize or optimize the operating of those machines. So it's not only a great value in terms of economic growth for the customers of CombiQ, it's also helping the world. And I think I'm going to end on that note. Thank you very much for listening, and I hope we have time for some questions as well. Thank you, everyone.
Thank you very much, David.
Thank you.
You recently started as CEO, and what skill set would you say that you bring into the company? And also, please share your vision for what you can bring in and what's going to come along for the company since you started.
Definitely. I want to start by saying that the founders, Rune Nordlander and Peter Wärmer, are still with the company. They've been doing this for 15 years with obviously an amazing track record. So they will keep on working with the investment side. We also have a really strong investment team working on a daily basis with finding and evaluating and developing the companies that we step into. From my side, it's going to be a lot to focus on driving First Venture, but in terms of the investment specifically, I have a background as a business lawyer and working with growth in different companies. So I think from the legal perspective, there are a lot of regulatory questions that needs to be addressed. And that could also help us identify potential risks and help the companies avoid those risks at an early stage. And from the growth point of view, I've been working at the H&M Group and at Daniel Wellington with growth and expansion questions. And that kind of experience can also be fueled into the portfolio companies and help them reach a broader market and grow quickly. And in terms of the vision and the projects ahead, I'm not going to give you numbers on how fast we're hoping to grow, but what I can say is that in connection with the IPO we did this summer, we acquired a lot of new capital, and the plan is definitely not to let that capital be resting on a bank account. We have big plans to put that money into action. So Mendy was the latest investment we did, but I'm hoping that we have a lot more coming up.
You mentioned risk, and you also mentioned that only 1 out of 9 companies actually survive the valley of death passage. So how do you address risk? How do you mention you have teams that really evaluate, but could you elaborate a bit on this, please?
Definitely. I think it's about first just identifying the risk and then daring to address them, be proactive. Because as I mentioned, we've done this journey numerous times with a lot of companies. And even though every single company is unique, you still have similar challenges that you are facing. And if you're starting your first company and you start to get traction, you haven't gone through this journey before. And I think we can come in with a lot of experience and knowledge on what pitfalls to avoid and the challenges we have to face, how to address them in a proper way.
So to build on your marriage analogy, you're more like a parent here, leading the kid through a rough patch.
Sometimes they're leading us. So it's really about giving and taking.
All right. Well, best of luck and thank you for coming.
Thank you very much.
Thank you. And now it's time for coffee. Let's meet back again at 20 after 10.